Hello and welcome to this short video on public finances. I will analyze one of the most fundamental questions in public finances, the composition of tax revenues. So how should the government raise tax revenues? Should it rather impose a tax on consumption or high tax on labor income, or rather on capital? Well, in the United States, the answer is clear. So the United States basically taxes capital and labor income and own consumption to a very small extent. And this is basically done on state level. And we wonder, is this really optimal? And in this video, I will show you, well, in the basic economic model, the neoclassical growth model, which we use for all our macroeconomic analysis nowadays, well, the implication is, well, you should rather tax consumption than labor or capital income. So let me present to you some facts about the US and its tax revenues. Well, total taxes, well, this is from the year 2015, but this hasn't changed that much, amounts to about 26% of GDP. And the large part is composed of taxes on personal income. And also we can add to this social security contributions, which are raised upon labor income. So these two together constitute more than half of total tax and social security revenues, 26%. And if you look at the second biggest component, then that's tax on goods and services, about 4.5% of GDP, or about 1/5 of total tax revenue. We can further distinguish labor income and capital income taxes. And in this figure here, you see the US labor and capital income tax rates during 1948 to 2008. And as you can see, capital income tax has fallen from a high level of about 50 to something like 35. And labor income taxes in the 50s, it was only 10%, including social security contributions, which is now equal to 30% approximately, basically because of high social security contributions. Now the question is, how should the optimal tax base be composed of? So if we distinguish consumption taxes tau C, labor income taxes tau L, and capital income taxes tau K, which one should the government use to finance its given expenditures, let's say on defense or on military or on running police and so on and so on? Well, we have the famous Chemley-Judd result that capital income taxes should be zero, but this result is derived in the case that consumption taxes are zero. And Chemley and Judd, they found independently that then labor income tax should be used to finance government spending G. Well, this only holds in the steady state, meaning in the long-run equilibrium in an economy, and we will focus on this. During the transition, it may be optimal to increase capital income taxation, but that's material for another video. So does the Chemley-Judd result also hold for consumption income taxes not equal to zero? Well, we look at a simple neoclassical growth model, the standard Ramsey model here. Households maximize lifetime utility given by equation 1, so they discount future utility by the discount factor beta, and U of utility, instantaneous utility, is a function of consumption and C and leisure 1 minus L. So we have normalized total time endowment to 100%. And some part we work, L, and some part we enjoy leisure, 1 minus L. And we use a standard Cobb-Douglas utility, so where the exponents gamma give us the weight of consumption and leisure in utility. And the household faces a budget constraint, so, and here we can distinguish the 3 tax rates. So he has to pay, or she has to pay, in consumption taxes tau C on consumption, labor income taxes tau L on labor income, W times TLT, and capital income taxes tau K on interest income, RT KT. So KT is our capital stock, our wealth, CT our consumption, WT is our wage per working hour, and R is our interest rates. We also receive transfers from the government, TR, and our capital depreciates at the rate delta. Standard budget constraint in the neoclassical growth model. And our government also runs a balanced budget, so we neglect any debt, but wouldn't change our results significantly here. And the government has to finance exogenous government expenditures G and transfers with the help of the three taxes. Now G and does not have any effect on utility or production, so it's just a waste in our economy. Let's hope that this is not the case in reality. And transfers are transferred back to households. Now, production side is standard, so production is assumed to be Cobb-Douglas, as specified in production function 5, and we assume perfect competition in goods and factor market as often in the standard neoclassical growth model. And we can derive the steady state condition, the long run equilibrium condition in the model. So the first equation is our standard Keynes-Ramsey rule, according to which utility today from consuming an extra unit is equal to saving this extra unit, getting the return 1 plus 1 minus tau k times r minus delta on the savings, consume it next period, but then we have to discount next period utility by the factor beta. So this is our standard Keynes-Ramsey rule, often also described as Euler equation, referred to as Euler equation. The second equation is an equation for the optimal labor supply, and here you can see the factor on the left hand side, 1 minus tau L over 1 minus tau C. This is the tax wedge. Here the government takes away labor income taxes and we can buy less consumption because of the consumption tax from our labor income. Third and fourth equation are the first order conditions of the firm. So the wage is equal to the marginal product of labor and the interest rate is equal to the marginal product of capital. And in equation 6e, we have the goods equilibrium in our economy. So total production, left-hand side, is equal to consumption, private consumption C plus public consumption G plus investment. In a steady state, our investment is equal to depreciation delta times K, and delta is our depreciation rate. And we close the model with the fiscal budgets, that we have a balanced public budget. So the total expenditures on government consumptions G plus transfers TR are equal to tax revenue from labor income taxation, capital income taxation, and consumption. All right, this is our steady state standard model, and you should be familiar with this. We calibrate this model for the US economy, so this is taken from work by Vito Polito and Mike Wiggins and myself. There we calibrate labor income tax to 28% for the United States, capital income tax rate to 36%, so these are the averages over the last 20 years. Consumption is only taxed at 5% in the United States. In some states you don't have to pay any consumption taxes, only on particular goods like petrol, for example. We use the discount factor beta equal to 0.96 so that we discount utility at a rate of 4%, and we choose gamma so that the labor supply is 30% of our available time. And we also have a production elasticity of capital alpha equal to 0.36, and intertemporal elasticity of 1 over sigma equal to 1/2, and our government share, government consumption in total GDP is 18%. Now from this calibration we derive that transfers are 16% in our model relative to GDP. And we can compute this steady state, get a value for government consumption G and for transfers at the amount of 0.0710 and 0.0638. And we wonder, well, is our tax our tax policy characterized by tau L equal to 28%, tau K equal to 36%, and tau C 5% optimal in the United States. So we have a relative large weight on capital taxation, capital income taxation. A large part comes from labor income taxation, 28%, and little on consumption, 5%. So the question, is this really optimal? And we look at tax policies, tau C, tau L, tau K, which imply the same government expenditures G and TR as in our steady state, in our benchmark, and wonder which one implies the highest utility of our household as measured by lifetime utility 1. And we restrict our eligible regions of the tax rate values to non-negative values. So we assume that we do not pay subsidies on consumption or subsidies on labor income or capital income. So we restrict it to be somehow plausible values, so it should be between 0 and 50% somehow, but not much more and not the negative rates. Well, what is the optimal tax policy? And the surprising answer, well, we shouldn't tax labor income and capital income at all. We just should tax consumption. So we should apply a consumption tax of 40%, a value-added tax on consumption of 40%, and 0 taxes on labor income and capital income, so that people enjoy going to work and people enjoy building up savings. That's really surprising at first sight. Well, it contradicts the US tax policy completely. So how do we explain this result? Well, in the model, we have 2 first-order conditions for the household. The first one is the Euler equation, the Keynes-Ramsey rule, how much he should save and how much he should consume. And the second one is this optimal decision, how much he should work, how many working hours he should supply. So let me explain the first one, the first equation. Well, you can either consume 1 unit, let's say $100 today, or you can save the $100 and consume next period. If you consume it today, you get your lifetime utility increased by your marginal utility in this period, let's say period T. This is the left-hand side. If you save it, you get the real return of 1 plus 1 minus tau K times R minus delta. And this provides you with a next period utility. Well, you have to extra utility, you have to multiply it by the marginal utility of consumption in the next period, which is partial U over partial CT plus 1. But next period, well, you're kind of impatient. You rather want to consume today rather than tomorrow. So you discount your next period utility in the period T plus 1 by the factor beta, which is smaller than 1. And in the optimum, you're indifferent between these 2 situations. Otherwise, it would make sense for you. For example, if the left-hand side is higher, it would increase your lifetime utility if you consume more today. And if the right-hand side of this equation is higher, you would increase your lifetime utility by saving more. The second first-order condition tells you how much labor you should supply. So you could enjoy 1 more unit of leisure. This gives you the term on the left-hand side of the second equation, the partial derivative of the utility function with respect to the argument leisure. Or you could work 1 hour and 1 extra hour. This gives you the extra wage WT. You have to pay taxes, tau L, so you only receive 1 minus tau L from your wage WT. And when you buy stuff, when you buy consumption goods, you have to pay value-added taxes tau C. So you have to divide this wage, this net wage, net of income taxes by 1 plus tau C to get the value, the number of goods you can buy in the next, instead of enjoying 1 hour of leisure. And you multiply the number of goods you can buy with your wage from working 1 extra hour by the marginal utility from consumption. And again, in equilibrium, in an optimum, you are indifferent between these two uses of your time, whether you enjoy 1 hour of leisure or work 1 hour. Otherwise, it would again make sense that you shift around this hour and either work more or enjoy more leisure, depending on which of the two sides of this equation is larger. Well, when you study these two first order conditions, it's straightforward what you should do. Well, to get to the first best location, you simply have to set tau k equal to 0 and the factor 1 minus tau L over 1 plus tau C equal to 1. In this case, you have exactly the same first order condition as a central planner in the Ramsey model, which gives you the first best allocation, the allocation that maximizes utility, given that you can also allocate some part of your income to finance taxes as you like. Okay, so we need to choose tau k equal to 0 and tau c equal to minus tau L. And then we have the first best allocation. This implies that in the first best equilibrium, we set tau k equal to 0, and now we have to look which tax base is larger. Is it consumption or labor income? And in the United States and in our model, consumption is larger than labor income. Therefore, we choose tau c, a positive value for tau c, and the exact same value, but negative value for the labor income tax rate. And then we set tau c and minus tau L, therefore, such that the consumption taxes tau c times c minus the labor income tax credit tau c minus tau c times W times L equal to our expenditures. So we raise government revenues from consumption taxes, and we also subsidize wages with the subsidy rate tau L equal to the consumption tax rate. All right. And of course, we need very high consumption taxes and labor income taxes subsidies to fulfill this equation. So it could easily be 500–600% or more. And these are not feasible. No, this is not feasible that you explain, let's say, a retiree who doesn't have any wage income, that he has to pay a consumption tax of 500–600%, 5 times, 6 times as much as you would pay without the fiscal authority. So we instead imposed the non-negativity constraint on labor income, capital income, and consumption taxes, and we impose that these tax rates cannot be higher than 50%. And then it's clear that, well, if we find that in the first best labor income taxes should be negative, capital income taxes should be 0, and tau c should be very large, then in the constraint economy where we cannot pick non-negative rates, it's clear that labor income tax should be 0, and then the rest should be financed by consumption taxes. This is no big surprise. Well, what other arguments do we find in favor for a consumption tax? As I alluded before, the efficiency argument, but this is not the only one. Well, we also think that consumption taxes might be fairer than a labor income tax. So let's consider a rich heir, let's say Paris Hilton, and let's assume she does not work. So if we do not have consumption taxes or low consumption taxes, she basically pays no taxes even though she's rich. We would consider this rather unfair. Now, if we switch to a consumption taxes, people who have never worked before but are rich because they are lucky to have rich parents, well, they also pay taxes, and we would consider this to be much fairer than a tax system which is only based upon high labor income taxes and high social security taxes. Well, there's an additional argument in favor of a consumption tax, and these are administrative costs. So consumption taxes are not really costly to implement, so value-added taxes, it does not take a large bureaucracy to administer it. But if you have the income tax, you know that to fill in your income statement is kind of a drag, and it also costs a lot of administrative costs, for public costs, which we have to finance. So we have to finance all these tax workers, public tax workers. And for example, when the Soviet Union was transforming from a communist state in 1990 in the revolution, Jeffrey Sachs told them, well, to install an income tax system is very cumbersome. Start with the consumption tax, value-added tax. That's much easier. And the reason is that you also save a lot of costs. There's a big problem, though, if you now want to implement a higher consumption tax and reduce labor income tax. Well, the transition from one system to the other is painful for some people. So let's look at retirees, for example. They lose. They have, in the young years, in the working years, they paid a lot of high labor income taxes in the United States. And if you now switch to a system with high consumption taxes and low labor income taxes, they have to pay high consumption taxes during their retirement as well. So they are the losers from such a switch, and we would have to implement it gradually so that there is no revolution in the street by the retirees. All right. Let me, in conclusion, point out where you can look up all these points. Well, the first argument that it might be beneficial to tax consumption is taken from an article of Coleman in the Journal of Public Economics. That this argument depends upon the assumption that people live a long life well, and on demographics is taken up in Rosa Gervais. So if we have a finite lifetime, well, then these results do not hold 100%. They have to be modified to a small extent. The data that I presented in the beginning is taken from my book in Public Economics. The methods are described in our new book by Alfred Maußner and me in the book on dynamic general equilibrium modeling, Computational Methods and Applications, 3rd edition, which is published in February 2024. The 2nd edition, of course, older editions are available from the year 2004 and 2009. And there's also sensitivity analysis with respect to inequality. So in a paper with Mark Trader, I look at the distributional effects of these reforms. Do not only consider a representative agent like in the standard neoclassical growth model, but at an economy with heterogeneous agent. And there we also find that consumption taxes are the optimal taxes, and that, well, efficiency gains would be something like about $2,000 to $2,500 annually if we switch to a consumption tax in the United States or in Germany. So let me summarize. A lot of theoretical evidence in public economics points to the use of consumption rather than labor income taxes, capital income taxes, and social security contributions on labor income. So many arguments are in favor of pursuing imposing a higher consumption tax instead, so that it makes sense for people to go to work again, work hard, and to build up savings. Well, let's see what's happening in the future if tax policies change in this way. Thank you for attending my little video.